Welcome back to the Money Show, and this is the time to get all your portfolio related queries answered by the experts, because we understand that there are a plethora of funds available in the market to invest your hard earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Amol Joshi, founder at Philanthropy Investment Services. And also, do not forget us to send your portfolio queries on a WhatsApp number, that is 865-797-4571, or you can also email us your queries on themoneyshow@etnow.tv. But with this, let's move forward and
Yes, I'm sorry.
start getting all your portfolio related queries answered. And the first query that I have is coming from Vikas. And Amol, Vikas says that he is 35 years in age and his aim is to earn 1 crore in next 15 years, as he started investing since the past 6 months, and his portfolio is as follows. So any changes required? He wants a suggestion. Currently, he is investing 15,000 per month in following funds, names such as Parag Parikh Flexi Fund, UTI Nifty 50 Index Fund, Kotak Emerging Equity Fund, Quant Small Cap Fund, where he is investing 3,000 rupees in total, so that sums up 12,000. Another 2,000 in Edelweiss Small Cap and Nippon India Small Cap, where he is investing 2,000 and 1,000 respectively. So all in all, he has 6 funds in his portfolio, Amol. And do you believe that investing in these funds with 15,000 per month can get him to rupees 1 crore in the next 15 years?
Right, because first of all, it's very heartening to see that you are working on a goal-based financial plan. You have a sizable goal of 1 crore rupees over next 15 years. To answer your question, you are starting with 15,000 rupees SIP. But if I take a complete full equity portfolio, the kind of portfolio that you have built, you would need probably I can assume a 12% CAGR from the market. You will need to invest at 20,000 or 21,000 rupees via SIP over next 15 years to accumulate 1 crore. Now, coming to your actual situation, since you have started only with 15,000, you will probably reach about 70 to 72 lakh rupees at 12% CAGR over next 15 years. But we don't have to lose heart. What you can actually do is you can probably try to do a SIP top up. As your income increases year on year in the business or profession or a job that you are in, if you do a 7% SIP top up, this 15,000 rupee SIP also will take you to the goal of 1 crore rupees. And coming to your second question about how about any changes in the scheme, I would say that for 15,000 rupees, you have 6 schemes. Probably this is 1 or 2 schemes too many. What you can actually do is increase your Parag Parikh FlexiCap allocation from existing 3,000 to 4,000. Increase your large cap component via Nifty 50 from your existing 3,000 to 4,000, and 4,000, 3,000 respectively in Kotak Emerging, which is a mid cap scheme, and Nippon Small Cap, which is a small cap scheme. So you'll have a well-rounded portfolio and not too many schemes to participate across all market segments.
Okay, so that's the advice coming in for Vikas. But Amol, the next question that I have is coming from Aman. This one too is an email query, and Aman has 5 SIPs of rupees 2,000 each in the names following as Axis Blue Chip, Axis Small Cap, Kotak Emerging Equity, Parag Parikh Flexi Cap, as well as HDFC Small Cap. Total 10,000 per month. His time period for investing is next 20 years. His questions are: firstly, are the SIP funds right? Second, total corpus at the end of 20 years that he should be expecting. So what's your advice on these that he should has outlook on?
Right. So are these SIP funds right? Ultimately, what happens is you cannot select any fund in isolation and then say or then expect that this fund will do very well over next 5 or 10 or 20 years. It does not happen so. The reason is that's why every mutual fund advertisement that you read or listen to has a disclaimer that past performance is not a guarantee for future results. So what do? You select schemes based on your investment horizon. If you are a long-term horizon investor, you should ideally go with equity schemes, which is what you have done. 20 years is a extremely long period of time. Coming to whether my SIP funds are right, I would again suggest the same thing what we suggested to the previous question, that for 10,000 rupees you need not necessarily have 5 schemes and increase your tracking load overall. Via you have chosen Parag Parikh FlexiCap. As the name suggests, FlexiCap scheme based on fund manager's discretion can participate across the market capitalization curve of large caps, mid caps, small caps. So I would say increase your Parag Parek FlexiCap exposure from existing 2000 equal weight to 5000. Kotak Emerging, which is mid cap, you can increase that to 3000, and HDFC small cap, bring it to 2000 to 3000. So that sums up your 10,000 rupees SIP. And your next question is, what will be my corpus? So this 10,000 rupee SIP, if the equity portfolio generates 12% return CAGR for you over next 20 years, you will be able to accumulate a nice corpus of about 92 lakh rupees. In previous question, we also mentioned something called SIP top up. SIP top up is nothing but you increase your SIP as your earning increases over a period of time. So same 10,000, but with annual 8% SIP top up, your corpus of 92 lakh rupees can go as high as 1 crore 59 lakhs.
Okay, thank you so much for that, Amol. And moving on to the third query then, and this one is a very interesting query coming in from Megha. A bit of a longish query, so please bear with me. But Megha says that she is a housewife aged 57 years. Recently, her husband sold a plot in her name for rupees 1 crores, and after the indexation, the capital gains come to 95 lakhs, and she has to pay 19 lakhs tax on it. What she is saying that she is not very keen on purchasing a second flat to avoid the capital gain tax. Does it make sense to pay the tax and invest the rest in mutual funds? And if so, please suggest the funds, or rather, is investing in the flat earning rentals for 3 years and then selling it and investing the proceeds in the mutual fund is advisable. So she has two options in mind, wants to know that which one she should actually go for, and her husband has retired. They are living comfortably with the monthly pension, and wealth creation for the long term to beat inflation is the only goal for Megha right now. So what will be your advice, Amol?
Right. So as you rightly mentioned, it's slightly longish query, but we are happy to receive such queries because a lot of information is provided. Let's go over those bits of informations. So Megha has mentioned that after her husband's retirement, they are living comfortably on their monthly pension. Number one. Number two, she has also mentioned her preference that she is not very keen in purchasing another property or another flat, and beating inflation is the only goal. So when you have so much of clarity, I think we all know what you kind of have to do if you have long-term capital gains from sale of residential property. You essentially have to buy another flat to consume those capital gains, or you can invest into Section 54 EC capital gain bonds. These bonds are issued by about 4 issuers, highest rated, and PSU or Government of India undertakings. That's option number two. Or option number three, coming straight, that's if you do not have those bonds. By the way, those bonds yield about 5.25% interest per annum. As we all know, this is pretty low. The interest rates are currently in a rising, have already risen in fixed deposits. And also this 54 EC bonds interest, this interest is taxable. So probably paying tax and investing the remaining lump sum is probably in your best interest, especially if you have a 7 to 10 years kind of 5 to 10 years kind of long term investment horizon. You have also asked us the recommendation on schemes. I would suggest break up your investments into 3 or 4 bits. Now, my allocation would be 40% of the lump sum can straight away go into ICICI Prudential multi-asset scheme. As the name suggests, this scheme invests into multiple assets, debt, equity, as well as gold. And remaining 60% component, you can equally divide 20% into each of HDFC Large and Mid Cap Fund, Templeton India Equity Income Fund, and Nippon Small Cap Fund, but via a 6 to 8 month of STP, Systematic Transfer Plan.
Okay, so that's the advice coming in from Megha. But with this, Amol, we are completely out of time in this edition of The Money Show. Would like to thank you for taking out time and helping all our viewers with their portfolio-related queries. Thank you so much once again, and have a good evening. But with this, viewers, it's time to wrap this edition as well. It's a goodbye from me and the entire team who put the show together. Thank you so much for watching.